Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Sorry about that. I had to clear my throat there for a second. Yeah, I hope I didn't blow anybody's ears out. But anyway, as the man said, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you hear something that you would like more information on this show, you can go to my website, and it's bullingtoncapital.com. There's a contact us page. You can fill that in, jot your question down, and I will try to get back to you as quickly as I possibly can. Or you can actually call, which might be a better idea. I have no idea what's going on, but our vendors are huge. Some of the biggest in their industries, financial services industry, one of the bigger industries in the world. We've been having an incredibly large number of issues, or they have been having them, not us. But their issue becomes our issue. And we've been spending an enormous amount of time sitting on the phone on hold waiting for tech support to come through. So if you've been having problems over the past few months actually, it actually started off during the pandemic because they were laying off staff, and you could see the response rates dropping and things taking a lot longer and things going down much more frequently. But that was really, in my mind, that was the start of this. And if you're working with really big organizations, sometimes it can take a little bit longer. So don't think that it's, my point to this is don't think that it's you. I know an awful lot of people, as soon as something goes wrong on the internet or they can't log into an account or anything happens, can't check my email, they often think it's them that's doing it. There's a really good chance that it's not you. There's a really good chance that whoever it is, your vendor, is making some changes, maybe some upgrades, trying to upgrade their security, and your stuff's not going to work for a while. And you just have to be patient. I know it's incredibly difficult, but a lot of the frustration that you see, we see the same things. And we deal with the biggest, best vendors in the financial services industry, and I'm just telling you, they have problems, and it's not their fault, not our fault. And they're working through it, and things are actually starting to pick up now. In the last couple of months, it's been improving dramatically. And so if you've been having a lot of tech difficulties, don't worry about it. I think it'll start to dwindle, and hopefully at some point in time we get back to where we were a few years ago. It's just a lot easier. It's a little faster, but we may not. I have no idea. All I know is we'll help our clients out. So I was going to start off by talking a little bit about the economy in general, excuse me, and then talk about some individual stocks. And I also, before the show is over, I want to talk about some fixed indexed annuities. And I know I've been talking about them for a long time. They can be very complicated. It took me several weeks of studying, and I've been doing this for 30 years. When I have to take several weeks to study a product, it's pretty complicated. And I'm going to try to simplify that to the best of my ability, because right now I think for an awfully large percentage of the population, I think they're a good idea. It's something that you may want to consider for a portion of your money. Now, everybody is different. I'm just saying that there's a large segment of the population who would benefit dramatically by taking a look at these and maybe adding this to your portfolio. Not in substitute of the whole thing. I don't think that's a really good idea in most cases. But which also brings me to another point. When most people talk, they come into a conversation with an advisor, okay? And they don't realize that they're doing this, but they come into it with a predetermined mindset. They have things that that work like they think they do, or that they hope works like they think they do. And oftentimes that may not be the case. And let me give you an example. Somebody that's in their early 40s calls up, looks at the long-term returns of the stock market or the S&P 500, and then he looks at returns on a whole lot of other things. A fixed annuity rate of return of 6 or 7%, not attractive. It's not attractive. That's why. Because somebody's shown him, a 10% return, what that would be over an extremely long time period versus, 6 or 7% or even 8%. And the gap is huge. See, the problem is the thing that they're not considering there is how much you pay for that extra return. That extra return is not free. You're going to earn that extra return. How? How are you going to earn it? Well, when you see the market go down 50%, you have to keep telling yourself, yes, this is normal. And I know they feel like somehow they're going to avoid that 50% decline at some point in time. Well, maybe you will. It will not be because of skill. It's going to be because of luck. Markets can and do go down. It's been down multiple times, 50% or more during my lifetime. There are multiple 10-year time periods where the return's been negative. And this is why it's really important when you sit down with a financial advisor that you're looking at those things. You're looking at, okay, if I don't have more than 10 years to go to retirement, I'd better have a fairly significant portion of my money invested in something that is that's got guarantees to it, so that even if the stock market goes down, I'm going to get a guaranteed return. What's the minimum guarantee I can get? And that's for I'm saying this for the averages. I've got clients out there, they don't need any guarantees. Heck, they don't even spend the money they get from Social Security and their pension. They're saving a couple $1,000 a month from the guaranteed income that they have. So they could easily be 100% stock, no problem. If that's how you'd like to go and you want to, I have no problem with that at all. Why? Because they really don't need the money. But if you're like the vast majority of people, you're probably going to have to use your IRAs during retirement to supplement your income. And you don't want to, maybe you've worked hard for what you got, and you just don't want to see it cut in half, because that would mean you'd be spending twice as much as a percentage than you started with. And that could end up depleting your IRA to next to nothing by the time you are ready to pass away. And that's rough. That's really rough. So that's kind of my point with this. It takes a long time to get your arms around all of these concepts. And quite frankly, most people never do. They just don't. Whatever they believe at the time they're 60 or 65, that's you're not going to change those beliefs. So I don't really mind. I mean, that's the nice thing I think about my industry, being an advisor. You can listen to somebody, you can ask them questions, and you can find out where they are. And that's the way the business should be done. You should be trying to find out how to help clients achieve the goals that they want to achieve. It's not about you. This is about them. Now, you have an obligation to know when those goals are not realistic. And you've got an obligation also to tell somebody, well, you know what, 15% a year, tax-free and complete liquidity, no charges, probably not happening. And heck, you get more than 6 or 7% a year, with all those other characteristics, probably not happening. At least not today. Look at all the different products that are available, and that doesn't exist. That doesn't mean you give up. It means you just have to be able to address the situation the way that it is. Try to take a look at what the risks are. And that's where an advisor is very helpful. We can lay out for you. Okay, if you had this percentage of your money in stocks, and you concentrated more on growth stocks than you do value stocks, or vice versa, whatever you want to do, whatever you're more comfortable with. These are some reasonable expectations. This is what you could reasonably expect to be able to generate in not enough income or generate an income and not run out of money before you pass away. And we've got all kinds of tools. I like the simple one. I've got a couple of really simple tools that are made available to me that they do all that planning. It doesn't take me more than, probably an hour. That's because I've been doing it for a long time. If you're brand new, you're probably 3 or 4 hours. Even if you've only got a year or two of experience in the industry, it's 3 or 4 hours generally just to get through all that material. But after you've been doing it for a while, there's some benefits to that. There are situations you're going to see over and over again. Not exactly the same, but close enough. And I think, horseshoes, hand grenades, and financial planning. Close counts. You can score in horseshoes without getting a ringer. If you get one, great. And it's the same way in financial planning. You may not be able to get that ringer every time, but close count. And you can get pretty close depending on what your goals are. If you start off early enough and you plan well enough, and it's not, when I say plan well, I get kind of, I don't know what the word is for it. It makes me a little uneasy, a little uncomfortable, because I see a lot of the financial plans that are out there, and people are asking people questions like that sports car you always wanted to get now that you're in retirement. Let's make a budget for that. And that's great. If you have the money for that, that's awesome. And I'm telling you, when you look at that 4% rule, it's 1 in 20 people. It's 1 in 20 households. 1 in 20 households are going to be able to retire and not have to worry about maintaining their lifestyle. It's 1 in 20. That's not a huge percentage. And when you think about it, if you had $1 million and you're going to spend, recommended somewhere between 4 and 5%, that's $40,000 or $50,000. That's not a ton of dough. If you added your Social Security to that, let's say you're a married couple, did fairly well, you'd have to accumulate the kind of savings. Well, you might have a little over $100,000 a year in income in retirement. Now, the fact that you have saved up $1 million means that you probably were pretty well paid or just extremely well disciplined. So if you're extremely well disciplined, you have an edge because you'll probably be able to make it on $100,000. You probably never spend $100,000 in your lifetime to get to that point by the time you're ready to retire. If you're not in that category, it's relatively simple. Again, these types of reports, you want to see, hey, this is where I'm at. Bill, can you give me a quick overview of where I might be if I keep doing what I'm doing? Yes, I can. It's going to take me about an hour if you answer the question. And the questions aren't that many. I'll talk about that as well. And I guess the point I'm getting to with all this is that I'm trying to make this a lot simpler. And that's my goal for the rest of my career. Try to simplify what our industry has made incredibly complicated, more so than it needs to be. I know I got a commercial break coming up here, at some point in time. Not exactly sure when it is, but okay, I take that back. I have 3 minutes. Oh, that's interesting. Okay, cool. But let me just give out my website again. So if you want to get in touch with me, you want to set up a phone call, you can come into the office, whatever you feel most comfortable doing, just reach out to me. Go to my website. It's bullingtoncapital.com, and there's a contact us page there. Just jot down a little note, whatever you want to talk about. It's funny, I get a lot of inquiries where people put their contact information down, an email address or something. Sometimes I'll put a phone number down, but they never leave the question. Like, what is it that you have a question about, just so that I could be prepared for the meeting? I don't mind. I mean, I'll still follow up and send you an email or give you a call. Hey, I'm not sure what you wanted to talk about, but I'm calling you back. So feel free. That again is bullingtoncapital.com. I'm on a mission. A remainder of my career in this industry is to simplify this stuff, because I'm telling you, our industry, there's so much stuff out there. Most of it doesn't pertain to you. So why would you bother? That's like sitting down and saying, hey, I want to learn about computers. Okay. Where would you like to begin? The same thing. I want to learn about financial services. Yeah, okay. Where would you like to begin? Honing in on those areas that are going to be most important to you, that's where a financial advisor can help. They can sit back and ask you questions. You're basically going back and forth and building. That's how you build a plan, incidentally. The plans don't have to be complicated. I think I have about 10 seconds before I have to take a commercial break. This is Bill Bullington. I'm right here on 1420. Stay tuned, because I'll be right back. Well, welcome back. Bill Bullington. I'm here every Saturday morning from 11 to noon. You can reach out to me if you'd like to. Go to my website, bullingtoncapital.com. And I was just talking about basic financial planning, retirement planning. That's what we do mostly. But you know what? All of financial planning, I learned a long time ago, was really compound interest calculation. So if you are able to do that, you can actually be pretty good at financial planning, because it all comes down to that. What do I mean by that? Well, if you want to have a certain amount of income, and let's say you're going to withdraw, start off with the industry standard 4% rule, and you want to have $100,000, you can, with compounding interest calculations, you can figure out how much money you're going to need in retirement to generate that kind of income. It's the same thing for college. If I'm going to pay for my kids' college or my grandkids' college, how much approximately do I think that's going to be? You can look those numbers up today fairly quickly. How old are they? That tells you how many years you have. Most people, incidentally, just put a certain amount of money away, whatever it is, a few $1,000s, to paying as much as they can into one of those accounts, and then you're going to let it grow. Try to let it grow, get them professionally managed. But it's basically compound interest calculation. So you make an estimate of what your goal is, where you want to be, when you want it to get there, how much are you able to put away towards that goal. Then you have to pick an interest rate. It's not as hard as it sounds, because the software does the heavy lifting. You just put your numbers in there, and in fact, I always show people how to log on to and be able to use some of the software that I found most helpful in doing that online, and it's a good tool. If you're just looking for guidance with your investments, that's great. I think where we are today, again, depends on how old you are, what you're trying to achieve. I think if you're young enough, there's the growth rate in some companies is huge. I mean, it is mind-boggling that these big companies like Microsoft, Facebook, Google, it's mind-boggling that they've been able to maintain the growth rates that they have at their size. That blows me away. And what's really wild, I think the industrial stocks, those are mostly technology companies. Industrial stocks are doing exceptionally well, and I think they're going to continue to do exceptionally well because there's a massive change going on right in front of our noses. A lot of us probably don't pay a whole lot of attention to it, or may not be aware of it, but it's the electrification of everything. I mean, everything is going electric. It's a really good idea, I think. I'll talk more about that on a future show. And it's also the digitalization of everything. I'm looking around. All my stuff now is, I have these vaults and super high software expenses just to keep my stuff digitally secure. That's kind of a big deal. But everything I do, I'm literally accessing over the internet. And it's mind-boggling. If you'd have told me when I started in this industry how I'd be running my practice today, I would have laughed. Yeah, right. I'll never live that long to see that happen. And but it is, and I love it. It's wonderful. That's why you don't even have to come into the office to have an appointment. We can do most things right over the phone now, which is kind of interesting. Most people do come in, and you're welcome to. And set an appointment and come in and, oftentimes I think it helps, being in person. I kind of prefer that way, but a lot of people don't. So we try to be accommodative. Anyway, one of the things I want to talk about, and this is one of the reasons that in-person meetings are kind of important. One of the better products, in my opinion, that you could consider today, especially if you're above the age of 50, and looking to retire at some point in time in your lifetime, I think these products, they're called fixed indexed annuities, and I didn't like them for a really long time period. They weren't that good, quite frankly, but they've changed. They've altered their structures, and they're willing to promise some pretty decent guarantees. I mean, I'm looking at 6, 7, 8%, depending on the company, is the income that they're going to promise you, or that they promise to make to you. By the way, it could be you and a spouse. So something happens to one of you, the spouse continues to get paid until both your lifetimes are over. And they're extremely competitive. I'm looking at it going, wow, most people don't make that much on their stock account. Most people don't average that much over their lifetime on their stock account. Why? Well, because it's a pretty high number, number one. Number two, it's incredibly difficult when stocks are fluctuating the way they are to stick with it. And quite frankly, a lot of people, unfortunately, they get caught. They have to take money out of their account, required minimum distributions for IRAs, or just money to supplement their income to live off of. And when you've got that in the stock market, and the stock market goes down by 50%, okay, that it's going to throw a wrench into that plan, and it's not pleasant. So anyway, this is much more. What should I say? It gives you a much higher degree of predictability, okay? And that's what we're looking for. So most of these will guarantee, and they have what they call an income, like a income rider or an income benefit value. That's pretty common terminology for these types of products. That's the number. Basically, that's the number that they're going to use to calculate how much income that you can get, that you qualify for. And every year that you put off taking income, it's going to go up. Okay? So when you sit down and you take a look at it, the starting, if you were going to start off taking income, the one I like the most, you have to wait 12 months to begin taking the income on, which is fine. You just keep that first year's income in a money market account, and you can draw it down. Just spend it. At the end of the year, you turn on the income benefit rider, and you're going to get that income until you pass away. If you put a joint annuitant on there, they'll take the younger of the two and calculate the income based on that. And something happens to you, your spouse continues to get paid. Something happens to both of you, whatever the account balance is that's left in there actually goes to your beneficiaries. Now, that's uncommon. Back in the day, when I first started in this industry, if you had an income annuity and you passed away, the insurance company was the recipient of anything that was left over with a lot of the contract. This was not a common practice back then. It's probably one of the reasons the insurance companies are so big. But anyway, so this has a refund feature. And they all have features that are similar to this. There are tons of these products out there. I feel that's one thing I really feel bad for. It took me a long time just to narrow down which companies I wanted to work with, and then to understand the differences between all those products. So that's actually how I made the decision, looking at the benefits that you were getting from each company, because they do differ from company to company. So anyway, the kind I like will guarantee a schedule of income. And I say, okay, here's next 10 years, you're going to retire in the next 10 years, and for every $100,000, I'm going to use that number because it just keeps the math easier. This is what we're willing to pay you. If you are going to wait 3 years, here's what you would get. And we will guarantee that. Now, if the investments should happen to perform better so that the investment's value is higher than the income benefit guaranteed value, that's the value that they use to calculate the income. If the investments were higher, you would get the same payout, only it would be on that higher dollar amount, and they would guarantee that. So, and they like to talk a lot about that, but I'm going to tell you that the chances of them outperforming the guaranteed schedule on the ones that I'm using are pretty remote, because those the guarantees are pretty high. And again, it depends on your age. So if you want me to run a quick proposal for you, and you're just curious about what that might be, just give me a call or send me an email. It's bill@bullingtoncapital.com. Go to my website, bullingtoncapital.com. These are significant. I mean, these are really significant. I was so glad to find this product because it's difficult. Let's say you have to withdraw 6%. You've got to do 6%. Well, if you do 6% in stocks and the market drops by 50%, there goes your 6%. You better not keep that up at that level, because you might have a tendency to run out of cash. It's just that simple. When the average is going to be, it depends on your age. Somebody in their 40s is not going to get a much more than 6% as a guaranteed income, if they even get that. So the bottom line is, I guess you just have to call. And the good thing is the call is free. It doesn't take me a long time. I don't have to gather a ton of information from you to be able to give you a projection on it. And we'll definitely do that for you. So anyway, one last review before I move on. You put money in, they guarantee there's a schedule that they're going to give you, and it's going to guarantee that income once you start it, wherever you decide. Like, say you started it next year, or 3 years, 5 years, 7 years. Mine's going to start 10 years after the time that I picked for it, at the time I'm eligible for full Social Security. And I'm not going to spend it. I'm just going to start taking it and reinvest it in other stuff. I'm going to take the safe stuff and invest it in stuff that's probably a little bit more aggressive. And that was my plan. That is my plan. Not going to need the income, so I'm just going to take it, try to build it up for my kids. I'm going to invest it into stocks because my kids are a whole lot younger than I am. And so that's my plan. Everybody has their own plans. I've never seen two plans that were similar. That's one of the reasons that I think it's kind of nice to be able to have an advisor you can talk to about, hey, what are most people doing? What do you think I should do? Ultimately, it's your money, so it's your decision. And I think that's something that doesn't get talked about enough. When there's no exactly right way to do things, there are a lot of wrong ways to do it, but you've got a lot of options, typically, no matter what your situation is. And some of them, it's a lot of the time, it comes down to personal preference. So there are some things that you definitely should not do. And having an advisor can help you go through and avoid those. But, like I said, I'll come back to that stuff on future shows. Just know that if you'd like to call in and talk about your position, your situation, what do I think? I've been doing this for so long, I can do it mostly over the phone, and I'll be glad to do that for you. Maybe give you a peace of mind. So I've talked about the annuities for income for retirement. That definitely you need to talk to somebody about. Those things are really complicated. Talked a little bit about the other options, which would basically be stock funds or balanced accounts that you might want to run as an alternative. Balanced accounts are accounts that have stocks and bonds in them and some cash. Right now, cash is paying almost as much as a lot of the bond funds are. That's pretty interesting. Is that going to last? I don't know. I nobody knows for sure. But at some point in time, the problem with having money market accounts is that when interest rates start to go down, you're going down with it. If you've got a fund that's being managed by professionals, they're probably looking at that and trying to they'll try to extend maturities on bonds, which would keep their interest rates a little bit higher for a little bit longer if they do it right. If they mess it up, man, it's not going to hurt them that badly as long as they're investing in short-term stuff. That's a big deal, by the way. But the percentages that you have in the various stock funds versus bonds and cash is going to be the largest determining factor as to how well you do. Now, having said that, I've seen a ton of people investing in funds that they do not understand. That is not good. That is definitely not good. They are investing in funds that were using leverage. What is leverage? Well, you can go out, you can take $100,000, and you can buy $130,000 worth of stock with it. You're basically borrowing money to buy stocks. And I don't think that's a good idea for an average investor. An average investor is nowhere near sophisticated enough to be able to keep up with that. And just watching it and then having to make the moves, all kinds of emotional problems exist. I just think it's a horribly bad idea. But when the market goes up, those funds will typically go up a lot more than the market does on average. And that's the attraction. But if you don't know how that's happening, and you shouldn't be in that fund. And again, that's an area where I think an advisor can sometimes help you understand how that could be putting you at risk. And that's a big one. I also see a lot of funds that, if you can dream something up, let's put it that way. If you can dream up an idea, good or bad, there's probably at least a half a dozen funds that are doing it. I mean, there are more funds than there are stocks. So the number of strategies that you could actually use are actually limited. There aren't that many strategies, but when we come back, I just got the heads up. I've got about 45 seconds until I have to take a real quick commercial break. So I'll just tell you again, this is Bill Bullington. If you have a question, you hear something you'd like more information on, feel free to go to my website, bullingtoncapital.com. Reach out to us there. I'll try to get back to you as quickly as I possibly can. And I'll be back for the last 15 minutes right after these commercial messages. And we're back. Hey, this last few minutes here on today's show, I'm going to talk about just a couple things. We're going to go through stocks. I know I've had a ton of people. I used to talk about this much more than I do now. And there's a reason for that. Not only am I older and have a much larger client base than I used to, with that comes a whole lot of work, a lot of extra work. And you really, if you're going to do individual stocks, you really need to get a system down. And this is just one. It's something I have done for a long time. It's been fairly successful. There are periods where it's incredibly successful, and then there are periods where you wish you'd never heard of the strategy. And it's called ride your winners and cut your losses. That's a lot easier said than done, I can tell you that. But anyway, so I've got these, they may not even be listening anymore because I don't talk about it all that frequently, especially when talking about products that will give you guaranteed incomes that are substantially higher than you can get on CDs. That stuff changes, fairly frequently too. That's why I'm not quoting specific rates. If you want to know where the current ones are, just give me a call. But when you're looking at individual stocks, man, you want to talk about moving fast. Holy cow. The speed's always been pretty quick. But just anymore, it's mind-boggling. And here's I'm going to give you an example. This is a company called Carvana. I remember when they came public. Okay? I don't know when that date was. Actually, I can tell you what it was. 2017. So they came public at somewhere around $10, and the stock got all the way up to $415 by the middle of 2021. It comes all the way down to under $4 in 2022. I mean, think about that for that is insane. And Carvana is that company that you see their commercials on television. You go onto their website, you look up your car, and you negotiate. They'll buy your car. They'll give you a bid over the phone. I've never used the service at all. I think it's a pretty clever idea. And I guess for a while there, after it came public for that first 3-4 years when the stock went up 3,000%, people thought it was pretty good. And then the price drops below the actual price that it came public at. I mean, why does it do that? And if anybody's ever been to one of my seminars, they know what I'm about to say. I'm just laughing about this because I've done so many seminars. We're going to get another one this fall, by the way. We're going to start the seminar program back up again. But the answer is, why does a company go from 15 to 400 back to under $4? It does that because it's a stock, and that's what they do. If you look at this long enough, and I've never reached out to this company. I should, especially since they changed the format of their software lately, and it caused me a heart attack trying to get up to speed on the new software. But it's a company called Telechart, and you can download all these charts, price histories from these companies going way back. It's a really nice product. It's a little more expensive now than it used to be, but it's not horribly expensive. Anyway, I set up my own scan, and I know what I'm looking for. I'm looking for a stock that's making a new 30-day high, that's in the top 20% of all stocks over the past 90 days. And otherwise, it's performing well. And today, when it shows up on my scan, it's because its average volume is about half of what the volume was today. So in other words, the volume's starting to increase. And the stock closes up in that upper half of that day's trading range. That's kind of important, the way that it closes. Next seminar, I'll go over this in detail. But anyway, Carvana came up on the list. And understand Carvana, that's the first reason I'm looking at it. It's got a price-to-sales ratio that's super low. Super low. I mean, it's so low, I would think that the people are probably thinking that this company is going to go away, it having gotten that low. Anyway, the bottom line is it just broke above an area of resistance. If you don't know what that is, don't worry about it. Next seminar, I'll show it to you. Or you can call me. I can talk about it over the phone. It's not that big a deal. But so anyway, the stock was up on Friday quite a bit. Actually, yeah, it was up 21%. Is that true? No, that's not true. Yeah, that's true. Wow, 21% on Friday. Anyway, it closed near the high of the day. It's got a really nice-looking chart. If you know what a cup and handle pattern is, it's kind of one of those, but I wouldn't worry too much about that if you don't know what it is. And if you look at it, half the people that I just said that to that understand it are going to disagree with it anyway. But that's okay. The stock's going up. Next one, Lithium Motors. This is what I wanted to point out too. So you've got two companies that are in similar industries, and they're both making moves at the same time. That just tells me that somebody that's out there in the institutional field has an idea that maybe cars and or transportation stocks are a good thing right now. That's all that really tells me. But it's good to keep in the back of your mind. Not my favorite pattern on there. It's a great big, there was a double bottom that it broke through, came back and broke down through the support there, and then turns around, goes back up again. Got to get used to that. But again, the stock looks okay. Here's one I kind of like a lot because the price to sales ratio on this, I'm old school. I like to buy something that's running up real fast right now that's also potentially undervalued from a fundamental basis. In other words, value investors might be interested in this just because it's a good deal based on the valuation. And so this is Weight Watchers. I remember when Oprah first got involved in that, man, she shot that stock way up. That was a long time ago, by the way. But after she started buying it, a whole bunch of other people started buying it for a while. And again, stocks are all over the place. Why? Because they're stocks. Back in, that stock came public, looks like it was 2002, right around, where is that price? Right around $30. It's up to almost, a little over 50, goes all the way down 3 years later, down to 18. From 18 goes all the way up to 80. From 80 goes all the way down to $3.77. Goes up and peaks at 26 a year later, comes back down to 11, goes all the way up this time. It goes all the way up to 94. And anyway, recently it had traded as low as a little over $3. Now it's at $8.26, and the stock looks like it's under accumulation. That could change in a day or two. Anyway, the symbol on that is WW. And when I'm trading anymore, I don't look too closely. I look at the price movement, and I look at the price to sales ratio. It's a valuation tool. And, next time we do a seminar, it's going to be somewhere in the fall. I'll bring that up, and I'll explain it to you. I'll even try to write this down before then so that I can give you a handout. You can kind of take it home. But it's pretty fun. And over the years, it's been really profitable. You can go for really long time periods, though, and not make any money, which makes it very frustrating. And then you can make a whole lot of money really quickly. And, once you've had those periods where everything you touched for a few months has gone up, you kind of think you're walking on water until the market turns around and becomes the market again. But if you can make money on a third of your transactions, you can actually be profitable, and I can show you how to do that. So not that I'm going to spend a ton of time on this, and not that most people should. I have a ton of my money in ETFs, and actually the vast majority of it. And I've got a pretty good chunk in the fixed index annuity because, again, when you look at the benefits that these guys are going to guarantee, most people are going to be really hard-pressed to keep up with that in their stock account. Their stock accounts won't keep up. And this is all age-related, by the way. The older you get, the less likely it is for your life expectancy to expand. Your life expectancy goes down instead of getting older. When your life expectancy goes down, an annuity company can afford to pay more money because the risk of you living too long has just decreased a little bit. So their risk decreases. They can afford to offer you more money, and they do. But if you want to see what that is, again, give us a call. And in the meantime, I'm going to get back to these stocks. These are the ones I just want to talk to you about today. These are the ones that caught my eye when I was going through the scans. This one's called XPL. They're shipping and logistics. By the way, horrible profit margins in that industry. This is one. This got in for a few reasons. The stock's range, it was up a lot. It was up 8% a day. Closed in the top 25% of the day's range. The volume's above average, and it looks like it's coming up off of a bottom. I thought the symbol was kind of funny. The symbol is PUMP, or pump. And no, it's not a company that deals in something naughty. It's actually a petroleum company, oil and gas equipment and services. And the name of the company is actually Pro Petro Holding Corporation. But I'm sure they thought that symbol was funny when they applied for it. Pump, P-U-M-P. Anyway, and here's this company's been around forever, the Vita Healthcare Partners. And this is a classic cup and handle pattern. If you guys don't know what that is, take a look at it. Symbol is DVA. Closed at 103. Was only up a couple percent. Volume started to pick up, but it looked pretty interesting. Now here's another energy, oil and gas drilling company. This one's called Transocean Corporation, and its symbol is RIG, R-I-G. And that is a classic breakout pattern. Broke right above $7.66. This thing's been significantly higher in the past. That stock back in the 2008 was $156, and right now it's $7.73. This is one of the reasons I'm not a buyer and holder. That's not as popular as it used to be, and thank goodness. And I saw so many people, buying all them long-term investors. Well, that's fine if you're in a fund. If you're in a stock, I can't tell you how many catastrophes I've seen. People that were holding something that had gone way up and then lost 95% of its value. And you look at the valuation on the stock and you're like, yeah, that thing, it may be another 10 or 15 years before it makes back a quarter of the money that you just lost. And so just not a huge fan. Now they hear the music, that means they're kicking me off the air. Just kidding. This is Bill Bullington here every Saturday morning from 11 to noon. Go to my website, bullingtoncapital.com, if you have a question. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.